Hello everyone, I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my top 5 most influential charts for this week. The first one we call the game board, and it shows where all the levels are in the S&P. If you know where these levels are, you can calculate your risk reward. You can calculate the extent of a move that you might see. So this is kind of where it all starts for us. So here we have the S&P 500 going back to 2020, Jan 2020, the entirety of 2020 so far. And you can see that major support, let's start there, is 31.26 down. That's down here at the 200-day moving average. Then what I would call your primary support is up at 33.94, which is about 50-ish points underneath the market. We actually tested that earlier this week. You can see that we came down and tested it on Tuesday, got close to what held. 33.94 is the 50-day moving average here in blue, and it's also the February 19th high that all this trouble started from, going from February to March. Up top we have 35.88. That is the high from back in September 2nd. So we're kind of stuck in this range here, and as long as we hold 33.94, the minor trend is up. You know, the tactical trend is still positive. Number 2 is market internals. The longer I do this, the less I concentrate or less I focus kind of solely on the price of the security or the price of the index, and the more I look at the internals around it. It basically gives us kind of an under the hood look at the market. We have 2 tactical models here at Asbury Research. One is called the Correction Protection Model, or CPM. We're not going to talk about that one today. The one we are going to talk about is the one that's a little bit easier to read, and that's the Asbury 6, and that's what we see right here. The Asbury 6 are 6 different indicators that we have back tested as a team, let's call it. We looked at a lot of indicators that I feel through my career have been very good tactical signals for the market. Every indicator has a weakness. A question I think all of us get as analysts is, what's your favorite indicator? And mine is, I don't have one, because they all have an Achilles heel. So what we did is some testing, and we found 6 indicators that kind of play as teammates. When one indicator fails, the other 5 tend to pick it up. So these are the Asbury 6. I'll go through them really quickly. The first one here is the rate of change in the S&P 500. It's actually the monthly rate of change. You can see that's been positive since October the 7th. That's the only one of the 6 that has to do solely with price. The other 5 are what I would call secondary indicators. They're not price, and those are the relative performance of stocks versus high yield bonds, investor asset flows according to the SPDR, high yield corporate bond spreads, trading volume in the S&P 500, and market breadth in the NYSE. All of these indicators are positive. That's why they're all green. It takes 4 or more of them to give us a signal, a directional signal. So in other words, 4 of these would have to turn negative or red in order to give us a bearish signal. They have been positive now since October the 5th. When all Asbury 6 are positive, market internals are the most conducive to adding risk to portfolio. So now we know we're sitting at a pretty good support level in the S&P 500, and underneath the hood, the market's in pretty good condition. Chart patterns. I've got a chart pattern here in the S&P 500 that targets a 4% advance. Let's have a look at it. What we have here in green is an inverse head and shoulders pattern. I don't put as much emphasis on these patterns as I did before. I think the algorithmic trading that goes on every day, it's about 75-80% of the daily volume, has kind of eradicated a lot of these patterns. But I do pay attention to the ones when we have a strong Asbury 6, positive reading in the Asbury 6, and when these patterns look like they're forming because of a point on the chart. And you can see here, basically, the left shoulder here in September the 11th, that was a 50-day moving average. Tried to get up above it, failed. Went down close to the 200-day on September 24th. Bounced back up. Had another little low here on October 2nd, right around the 50-day. So you see a lot of kind of hovering around the 50-day moving average here. I think that gives the pattern some integrity. It targets a 4% rise to 35.88, and that will remain valid above 34.03, which is the 50-day moving average, and which goes back to our support level that we were looking at in the previous chart. So basically above 3,400, we are set up to retest the highs that we made at the beginning of September. Number 4, follow the leaders. Watch Biotech. We do a lot of work here looking at linear correlations between different indexes from different countries, certain key stocks. We want to kind of see what tends to move up and down with the market, with the S&P 500. And we had a breakout here in XBI. This is another chart pattern here. This is actually a symmetrical triangle. If you're a classic chartist, we just mark them as investor indecision. I think it's easier for everyone to understand what they are. And basically, the market tends to trend for a while, as it did through July 21st. It then stalls. People think the market's too high. People are taking profits. Maybe some news comes out that they don't like, earnings, what have you. Now it starts to coil. Coil gets smaller and smaller as people get more and more reticent to buy a higher high or sell a lower low. Finally, get a breakout, and we got that on October the 7th. That indicates that this bigger move that started back here in the middle of March is re-engaging. This targets an additional 13% higher up to 132. Positive correlation to the S&P 500. This is a linear correlation, has been very tight and stable for the past 10 years. So I'm looking at this as another indication that the market's targeting higher prices. Investors are collectively targeting higher prices. So this pattern has to stay up above 113.90 in order to remain valid. If it does not, if we fail here in biotech and we blow through 113.90 on the downside, now I'm going back to my other charts to see what the Asbury 6 looks like. Are we starting to lose positive constituents? What does the S&P 500 look like? I'm turning over rocks to find other signs of weakness. So I kind of look at this as something that should lead, if we are indeed going to go back and retest that September high in the S&P 500. Finally, mean reversion. Market is getting out over its skis a bit. This is the S&P 500 up top going back to 2000. And this is the percentage that the S&P 500 is above its 200-day moving average. It got up to as high as 13.3% last week, and we've backed off a touch from there. But you can see about 14% is the high of 20 years. It's about as far as the rubber band got stretched, so to speak. And you can see a lot of these highs coincided with some important highs in the S&P 500. So for perspective, in February, right before we had the February-March collapse, I think we were like 12.8 or 12.9 or something like that above the 12.9% above the 200-day moving average. So we're a little higher than we were here back in February. You can see it here. I'm pointing to it. This is not a sell signal. This tells you the market is a little stretched out. So the next time something bad happens, the Asbury 6 turns to negative, XBI fails to hit its target and breaks that support level we talked about, the pattern in the S&P 500 fails, this tells me that I've got to get ready for maybe a little larger pullback than your typical 5 to 6% little move down, maybe back into the 50-day moving average. This suggests the market is susceptible to a little bit more weakness because of its overstretched condition. So there you have it. There's your daily 5. Thanks for watching.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.